ROI formula most marketers use is technically correct. It's also regularly misleading. Here's the hidden assumption almost everyone skips past. The standard marketing ROI formula is revenue from the campaign minus campaign cost divided by campaign cost, multiplied by 100 to get to a percentage. Spend £5,000 on paid search, generate $20,000 in revenue, that's 300% ROI. It is a genuinely useful number. It tells you whether the spend paid for itself and by how much. For isolated direct response campaigns where every sale is clearly tagged to one channel, this formula does exactly what you need. The problem though isn't the maths, it's the assumption hiding inside it. The formula assumes every pound of revenue counted would not have arrived without the campaign, and that's often wrong. Say you run a promotional email in December. Sales go up, but sales were already trending up because it's December. Some customers would have bought anyway. Some came through a retargeting ad running simultaneously. And when you attribute all that revenue to the email, you're not measuring what the campaign did. You're measuring what happened while that campaign was running. Seasonality, organic growth, and overlapping channels all inflate the number. The formula looks clean, the attribution underneath isn't, and that's where a different approach can come in. Incremental measurement asks a different question. Not what revenue did this campaign generate, but what revenue would we have lost without it? If your business was already growing before the campaign launched, some of that growth would have happened regardless. Incremental measurement isolates only the revenue the campaign actually caused by comparing results against a realistic baseline. In practice, use pre-campaign sales data as a reference point, or run holdout tests where a segment of your audience sees no campaign at all. Of course, it's more work, but it gives a more honest picture of what your spend is doing. And it's worth noting that no method removes all uncertainty. Time lags between spend and conversion are real, and multi-touch journeys are hard to unpick. Incremental measurement reduces the noise, but it doesn't eliminate it. Here's the decision rule. Use the simple ROI formula when attribution is clean. A single channel, a direct response mechanic, a clear link between spend and sale. Paid search with the conversion tracking is the clearest example. But switch to incremental thinking when channels overlap, organic growth is present, or brand spend is involved. Brand awareness campaigns rarely produce revenue you can tag directly. Running Google, Meta, and email simultaneously makes it impossible to know which channel closed the sale. In those situations, the simple formula will flatter you. The honest question always is, would this revenue have arrived without the spend? Match your measurement method to your campaign type before you calculate anything. If that was of value, subscribe to the channel for one real business question answered every video. For the same clarity in writing, the website and newsletter is 5minutebusiness.com.